Ladies and gentlemen, my name is Samir Shah and I'm an M&A partner in Khaitan and Company's corporate M&A group. Welcome back to our second edition of our M&A Academy program. We had a very successful run last year with 10 webinars, and each of those webinars was aimed at providing foundational legal knowledge and understanding to corporate executives, in-house legal teams, and other M&A ecosystem participants on M&A transactions and processes. The feedback was so overwhelming and so motivating, both from participants who attended live as well as people who saw the videos online, that it motivated us to renew the program, of course, with new topics and formats. Our subject today is the anatomy of term sheets in M&A transactions. Usually, while a share purchase agreement or an asset purchase agreement is the end goal of a transaction, the beginning is far humbler in origin, content, and manifestation, however, no less important than the end objective itself. This is in the nature of a term sheet. And in last year's program, our partner Ashray Rao delivered a very comprehensive presentation on term sheets. And some of the participants left that session with a feeling that perhaps we should also have taken a live term sheet and taken people through the journey of that term sheet. So lo and behold, we have curated today's session for precisely that purpose. As always, we have a formal presentation, but with one departure in format. We typically have a Q&A session with audience questions after the presentation, but in this webinar, we will also take questions live. So please feel free to keep submitting your questions using the Q&A chat box. We will also respond offline over email after the webinar to all questions. And we will also send you the presentation, the summary notes, and the recording. Mind you, the recording will not only be shared with all participants, it will also be uploaded on YouTube as we have done for the earlier edition of the M&A Academy. Next slide, please. So to introduce our speaker today, we have with us Tanvi Kumar, who is an M&A partner based in our NCR offices, although she works on projects nationally. She has more than 15 years of M&A experience. We circulated her profile over email to the participants, but just to mention once again that she is an experienced and knowledgeable M&A practitioner. Having gone through the presentation and the term sheet with her beforehand, I'm sure this webinar will be worth your time. So without further ado, I now invite Tanvi to deliver her presentation. Over to you, Tanvi.
Thank you, Samir. Thank you for the introduction, and I once again welcome the audience for this year's first M&A Academy webinar. As Samir mentioned, the theme of today's webinar is to explain the key concepts and terms in relation to a term sheet using practical illustrations. For this purpose, we will be using a real term sheet from one of our marquee transactions. The term sheet, of course, has been anonymized and facts slightly changed so as to protect the confidential details of the transaction. Next slide, please. So as part of today's session, we will start by going through the factual matrix and the structure of a term sheet. We will then go through key clauses of the sample term sheet to illustrate key binding provisions, key commercial terms, deal conditions, risk allocation, governance and minority protection, and exit rights. We will end the session with some drafting tips and then open the floor to the questions from the audience. We will, of course, as Samir mentioned, be taking some questions live, but if we get the time towards the end of the session, we will also add on to additional questions that the audience may have. Next slide, please. So now, before we go into the various provisions of a term sheet, let me just quickly run you through the broad factual matrix of the deal in the context of which we have taken the sample term sheet. So the acquirer here is a strategic buyer who proposes to acquire 51% of the shareholding of a private company engaged in manufacturing business. A and B are promoters of the company, with Dr. H being a key employee and a technical expert who oversees day-to-day operations of the company. The business is highly specialized, and the commercial understanding of the parties is that A, B, and Dr. H shall carry out day-to-day operations of the company for 3 years post-completion with an equity incentive built in. In this particular case, there was high dependency on the promoters and a long transition period before the acquirer could gain control of the business, although the economic interest of the business was to be to the buyer's benefit immediately upon closing. Due to such a dependency, an appropriate incentive arrangement was agreed, wherein the promoters and the key employee shall retain a minority shareholding in the company such that they receive value and benefit of the business that they carry on and the value that they create. As part of the transaction, the acquirer had agreed to provide funding commitment for achievement of the business plan. The business depends on one of the plants owned by an affiliate of A and B, let's call it XYZ. And the key commercial understanding of the parties was that there will be an internal restructuring implemented whereby XYZ would become a subsidiary of the target company so as to ensure continuity of operations and also to consolidate the business and the value. This is another interesting aspect which is common in transactions where the business of the target entity has high dependencies on associated or affiliated companies of the promoters. And in such case, it is imperative that either a transitional arrangement for supplies and services is put in place for a fixed period of time post completion, or in some instances such as this, certain pre-completion restructuring is envisaged. Lastly, upon expiry of the 3-year term, the remaining shareholders, as we call it, which is A, B, and Dr. H, were agreed to be provided a right to exit. Next slide, please. So before we jump into the structure of the sample term sheet, I would quickly like to recap the basics of a term sheet from last year's session. Term sheets, also known as letters of intent, MOUs or memorandum of understanding, expressions of interest, heads of terms, are usually entered into right at the beginning of an M&A transaction before the parties have incurred significant costs or have began their due diligence. The primary purpose of a term sheet in an M&A transaction is to outline the main terms that have been agreed in principle and provide a framework to the parties for drafting and negotiating the definitive agreements. Term sheets are therefore beneficial for various reasons. Of course, they give an expression of interest from both parties. They provide a written confirmation of the principal terms or the key commercial aspects of the deal, which helps achieve commercial alignment quicker at the definitive agreement stage. Having said that, parties should avoid prolonged negotiations and unnecessary detailing at the term sheet stage. Accordingly, time spent at the term sheet stage should not be disproportionate to its benefits. When we talk about the form or a format of a term sheet, there is no standard format. Term sheets or heads of terms can vary from a simple letter form, which is most commonly used, to a detailed standalone agreement or a deed. The structure, however, of a term sheet would largely remain the same, which will comprise of the parties, the description of the proposed transaction, the key terms, and the execution pages. Now, in terms of going a little further into the parties to a term sheet, usually the promoter or the key shareholder and the acquirer may be parties to a term sheet. It is also not uncommon to have the key individual decision makers from the buy side as well as the sell side to enter into a term sheet, especially in cases where there are multiple sellers, and where cap tables are quite disjointed. It may be preferable for one of the key shareholders or a key investor to sign the term sheet, because at the term sheet stage, it may be challenging to get everybody on board. And accordingly, the signatories are limited to a limited set of people. However, if there are any binding obligations or certain key commercial terms envisaged, wherein a particular party is deriving either benefits or has certain contractual obligations in the context of the larger deal, then such a party may be made a signatory or a party to the term sheet. Examples of this could be a guarantor or a person who will be giving or taking any benefit of the direct and contractual obligations under the definitive agreement. For example, in our sample term sheet, since there was an internal restructuring envisaged whereby XYZ entity was to be made a subsidiary of the target company, XYZ was made a party to the term sheet. In terms of the description of the proposed transaction, this is largely just setting out the basic structure of the transaction, whether it is purchase of shares, sale of business or assets, whether it is a minority deal or a majority, what is the percentage shareholding. So it's basically to set out the basic tenets of the deal. Key terms, of course, we will go through in a little more detail as we proceed through the session. And then, of course, there are those execution pages. Next slide, please.
So maybe, Tanvi, just very interestingly, and I know this is the slide we have to cover, our first question of the day says, should the term sheet or MOU be binding or no binding? I think they meant not binding. And what are the pros and cons? What in practice is the more common approach or basis
Sure.
for one approach or the other being taken? So you get the drift.
So sure, I think I'll just answer the question on what is it that we more commonly see. The more common form of a term sheet used is where term sheets are non-binding, but identified or specific provisions of the term sheet are given binding nature. I will of course explain it as we go through the session. However, there may be instances where, especially in complex matters, where there are a number of interdependencies, certain conditions are absolute and must, and in that context, to the extent term sheet provides for those key commercial terms which are sacrosanct, parties may commercially decide to keep the term sheet binding. But the more common function is essentially having a non-binding term sheet with certain binding provisions. In fact, when you can see the sample clause that we have, which also lists down the fact that, in the sample term sheet that we took, it was a non-binding term sheet with certain binding obligations and binding provisions, which were basically the governing law, confidentiality, and exclusivity clauses. It is also important, I think, when we talk about the binding nature of a term sheet, to be careful to particularly provide for what the intent is. We have seen instances where even in non-binding term sheet, there is a potential liability for misrepresentation or negligent misstatement which may ensue. Therefore, including a broadly drafted entire agreement clause when parties go on to sign the definitive agreement becomes important. This clause will essentially exclude all liabilities for any pre-contractual representations from either side. Sometimes in the term sheet itself, the parties may include a provision which would say that there are no warranties, representations, acknowledgements, commitments given by either party in the term sheet, and all warranties, etc., will be set out in the definitive agreement. So I think that becomes important to clarify in the term sheet what the binding nature is. I would come now to specific provisions or the binding provisions of the term sheet. Let me first take the confidentiality provision. Now, confidentiality provision helps restrict parties from disclosing information obtained during discussions and due diligence and negotiations during the deal discussions. In case of a confidentiality a clause, sometimes confidentiality agreements or non-disclosure agreements may be entered into prior to execution of the term sheet itself. In such instances, the term sheet could basically acknowledge the continued application of such an NDA or a confidentiality agreement. However, if parties have not entered into a prior NDA or a confidentiality agreement, then the party should consider including a long form legally binding confidentiality agreement in the term sheet. This is important from a seller's perspective, as upon execution of the term sheet, the buyer will initiate its due diligence exercise, in the course of which the seller will share a lot of data in relation to the target. A lot of sensitive information may be shared, and that should be shared strictly on a confidential basis. Also, from a buyer's perspective, it may become important, as the existence of the term sheet and the contents of the term sheet may be considered confidential, to avoid a situation where seller is actually disclosing the terms offered to it to third parties or competing buyers. The key aspects of a confidentiality clause is therefore the scope of the confidential information, the nature of the obligation, which is to keep confidential or not to disclose or not to use, and the exclusions to the confidentiality obligations, which are usually disclosures required to enforce rights of the parties under the term sheet, disclosures required under applicable law, or disclosures required to employees and advisors strictly on a need-to-know basis, provided such advisors and employees are also bound by similar confidentiality obligations. Again, there may be additional binding provisions such as the cost clause, which clarify that each party will be responsible for its own costs, or in some instances, depending on the commercial arrangement between the parties, if one of the parties is bearing a material cost in relation to a particular action item, that may be spelled out along with, if there are caps or thresholds prescribed. Governing law and dispute resolution, again, is an important provision which is of binding nature, to provide for a mechanism for dispute resolution in the event differences and disputes arise between the parties in the course after signing off the term sheet. Usually in cross-border M&A, we see institutional arbitration being provided as a dispute resolution mechanism for any disputes in the term sheet. We can go to the next slide. So I'll come to one of the key clauses, one of the most important clauses which are of binding nature usually, which is the exclusivity clause. Now, an exclusivity agreement, sometimes called as a lockout provision, a shutdown provision, or a no-shop provision, seeks to prevent the seller from negotiating with or soliciting offers from other parties for a fixed period of time, which is the exclusivity period. It gives the prospective buyer a period of exclusivity to carry out its due diligence and negotiate the definitive agreements with a view to completing the transaction. This also helps the buyer avoid a situation where rights negotiated by it are presented to competing buyers. If we refer to the exclusivity provision from the sample term sheet, this refers to the exclusivity period. This is drafted broadly to restrict the parties not to solicit offers in any manner, directly, indirectly. It broadly defines the restrictions, which is a restriction to initiate, encourage any inquiry, discussion, or proposal, propose or continue to negotiate, enter into any agreement or understanding, providing for, and then it goes on to what the restrictive activity is. Again, from the perspective of drafting an exclusivity provision, the restriction is not only to negotiate and solicit offers for the deal structure envisaged by the term sheet, but also to keep the drafting open to forbid discussions for any other deal structure. So, for instance, here you would see references to acquisition of shares, all or part of the assets or the business, and signed term sheets, etc., in relation to that. So this is done again just to capture both anticipated transaction structure as well as forbid any discussions or solicitation for any alternative transaction structures. Term sheets generally provide that the consideration for the seller entering into the exclusivity obligation is the time and expense incurred by the buyer in carrying out its due diligence. So in some ways there is a mutual conduct and mutual rights created between the parties. However, if there is any doubt to the adequacy of this consideration, sometimes we've also seen buyers prescribing for payment of a nominal sum under the term sheet for these exclusivity and other binding provisions to be enforceable. Of course, as I said, where the term sheet imposes confidentiality or other obligations on the buyer, as well as an exclusivity obligation on the seller, the issue of consideration should normally be adequately covered by mutuality of the parties' undertakings. Of course, the term sheet, as we have previously mentioned, should clearly identify the binding nature of this provision. Next slide, please.
So before we move to the next discussion, Tanvi, there's a host of questions on exclusivity and they're still coming through. Let me pick two of those questions. The first one is, can you give examples of real life exclusivity clauses that a potential buyer has enforced or tried to enforce?
Sure. So I think in the course of advising on a number of transactions, we have seen instances where parties have tried to enforce the exclusivity provision or some of these binding provisions. I would rather take an example of something that is in public domain. So last year, for example, there was a dispute which was referred to the Delhi High Court between Zolo Stays and Oravel, wherein the parties had entered into a similar term sheet, which was a non-binding term sheet with similar provisions which were of binding nature. The parties had negotiated definitive agreements, but had not signed the definitive agreements. In that instance, the dispute, and then essentially the seller, which was Solo Stays, basically tried enforcing the term sheet on account of the buyer then trying to walk away from the deal. And this was then referred to an arbitral tribunal. The arbitral tribunal held that because the parties had frozen and agreed form documents, and because they had started and in fact fulfilled conditions envisaged therein, there was a relief for specific performance granted to Zolo. So that's one of the examples that's actually there in public domain, where a term sheet was enforced and absent definitive agreements, the relief of specific performance was granted.
Okay, and maybe just the other question. So there seem to be a couple of different questions on how do you extend the exclusivity period. One specific question says, if the company is taking too much time to give us the diligence information, can we provide for an automatic extension of the exclusivity period?
Sure. So of course, a lot of this depends on the leverage of the parties. But I would definitely say that such a provision which prescribes for an automatic extension of exclusivity on account of the seller not providing or delaying provision of information for the completion of the due diligence process is not the most usual one. Let me put it that way. Because what will happen in this kind of a provision is that whether there has been a delay by the seller or not will always be a matter of dispute. So really, I mean, if the buyer has that kind of a leverage and bargaining power, then the buyer may provide that if in its opinion there is a delay in provision of this information, the exclusivity period will be extended automatically. However, in most instances, the seller will basically resist having such a clause and leave it for a good faith obligation, for instance, to be provided in the document, wherein the seller has an obligation to ensure that all due diligence information is provided to the best in good faith and in a time bound manner. Samir, should we go to this slide?
Yes.
Or
yes, of course.
Sure. Okay, thanks. So I think then we come to the term of a term sheet. Usually the term sheet is to operate from the period of the execution of the term sheet until the parties enter into definitive agreements. There may also be a fixed exclusivity period provided, on expiry of which the term sheet will automatically terminate unless extended by the parties. And for that extension, there could be various permutations and combinations as to how parties want to prescribe for it. An important provision is also that upon termination of the term sheet, the accrued rights of the parties will survive. So that's what you also see in the sample clause that we have taken here. And this is essentially to provide and address a situation where if there are any rights or created under equity, then those rights or to proceed against each other are preserved. We can go to the next one. So I think before we delve into the key commercial terms as provided in the samples term sheet, let me refresh your memory on a few key terms that should ideally be included in a term sheet from last year's session. Typically, a term sheet should set out details of the main transaction documents and ancillary documents envisaged to be executed for implementation of the proposed transaction. It should set out the transaction structure broadly. It should set out the broad commercial details or commercial terms agreed between the parties. One of it, of course, is the purchase consideration. This is one of the most important terms to be clearly set out in the term sheet. Associated provisions are the payment terms, if there are any adjustments or any holdbacks anticipated or agreed between the parties. And then, of course, if the parties are to continue as shareholders post-closing, then some of the key shareholder agreement terms, such as how the governance will work, and if there are any other transfer restrictions or exit provisions which are principally agreed between the parties. Next slide, please. So here, from the sample term sheet, this is the main commercial term agreed between the parties, wherein the acquirer agreed to purchase 51% of the shareholding of the company. There was a further investment of the investment amount which was envisaged, and the total consideration was arrived at and agreed to between the parties based on an agreed enterprise value. If you see the last sentence of the sample clause, this also prescribed that the sale consideration shall be paid in cash at closing, and the investment amount, which is the subscription amount, shall be called in tranches, the first of which was payable at closing. So some of the things that are the key tenets or the key commercial terms agreed between the parties need to be set out clearly in a term sheet. This would be the proposed investment size or the consideration amount, the percentage of the shareholding proposed to be either subscribed to or purchased, the agreed valuation, if there are any assumptions to the valuation. For example, in this case, we see the enterprise value, but if there are any other matrices based on which the parties have agreed to the valuation, then those have to be clearly set out in the term sheet. And in relation to the consideration, if there are any adjustments, deferred consideration elements, any holdbacks, any escrow arrangements proposed, then that should be also set out in the term sheet to avoid reopening of some of these basic terms, which parties may, which may form the basis of entering into the transaction. So as I mentioned, the consideration payable is always the fundamental issue for both the parties. And so clauses documenting this aspect are one of the most important clauses. The simplest form of the consideration clause is a single pre-agreed cash payment of consideration at closing. More complex mechanisms for determining the consideration and satisfying purchase price may be there, and they may include things like completion accounts, where the purchase price is adjusted after completion by reference to an agreed financial metric based on accounts which are drawn up close to or as at the closing date. There may be deferred consideration, which is a part of the consideration payable after the closing date, and mechanisms or conditions attached to such payment. Retention, where a part of the consideration may be held back by the seller, either for held back by the buyer, either for the seller to fulfill certain conditions or satisfy any indemnity claims that it may have. A variable of this is also the escrow arrangement or a closing escrow arrangement, wherein for satisfaction of such indemnity claims, a part of the consideration is then deposited in the escrow. So there are various combinations of how a purchase price may be derived at as well as paid. But if there is a basic commercial understanding around these provisions, it's best to sort of set these out at the term sheet stage. The detailing and the mechanics of this can be left to the definitive agreements, but the basic understanding may be set out in the term sheet. Now, if in terms of the mode of payment, usually when we talk about situations where there are multiple sellers, such as in this case, the apportionment of payment of the consideration to these sellers may also be clearly set out in the term sheet. This just avoids, a lot of protracted negotiations that can go on among the sellers and therefore then impacting deal timelines. As I mentioned before, if there is an adjustment envisaged, then the level of detail that should be included in the term sheet in relation to this mechanics will really depend on the circumstances of the transaction. So, for example, if it's a straightforward transaction, it may be just preferable for the term sheet just to summarize the general principles of the adjustment and leave all the detail, such as the timing for producing accounts, the agreed adjustments, who will prepare the accounts, etc., to the definitive agreements. However, if the price adjustment is more complex and there are different levels of adjustment that are envisaged, the parties may even prescribe for a detailed formula or specific basis for determining such a financial adjustment or metric, or in some instances even to set out the line items for adjustment in a schedule and provide for an illustrative example as to how the adjustment will be implemented. Again, where there is a subscription envisaged and the investor or the acquirer proposes to subscribe to convertible instruments, then the terms around the conversion may be set out in the term sheet. This could be the conversion formula, or if there is a particular ratio envisaged. Next slide, please. I think, as I mentioned before, one of the key commercial term of the transaction in this case was the financial commitment of the acquirer, where the acquirer had agreed to keep funding the business requirements of the target company based on a business plan towards its working capital and other requirements. And there was an amount as well that was envisaged. So this key deal term was set out in this clause. If we see limb B, the mode of payment or for this capitalization was also set out, which was meant to be arranged from a bank loan, and in absence of that, a direct lending by the acquirer into the company. As a broader deal term, what was also agreed was that if the business is not performing at an optimal level and the corporate guarantees of the company and the acquirer are insufficient to bring in the capital that is required to achieve the business plan, then personal guarantees of the remaining shareholders, which were the selling shareholders in this case, will also be available. So this was done to ensure that the milestones envisaged for both the parties for achievement of the business plan are insulated from any risks of availability of capital. Next slide, please. So then we come to the conditions that must be satisfied before a buyer will be prepared to enter into a definitive agreement or to complete the proposed transaction. These conditions should be clearly drafted so the parties know what needs to be done to achieve deal closure. The aim should be to minimize the scope of disagreement further down the line. However, as a practical matter at the term sheet stage, the buyer would not have undertaken its due diligence. And therefore, for the buyer to identify specific and objective conditions may be challenging. And therefore, at the term sheet stage, we would find most of these conditions drafted in a broader and a more generic manner. Even though the conditions themselves do not have legal force, these are indicative. And if a lot of detailing is done at the term sheet stage, we have seen instances where sellers argue then at the time of negotiation of the definitive agreement that in some ways the conditions set out in the term sheet were exhaustive enough, and therefore any additional conditions were implicitly conceded by the buyer. So therefore, it's ideal at this stage to keep the drafting flexible, inclusive, and non-exhaustive. Now, where you see limb 1 of the sample clause, this is the condition for completion of the due diligence. The acquirer may prefer keeping the areas of the due diligence inclusive to give them flexibility to further diligence additional aspects of the business. The due diligence condition usually prescribes that the condition of the completion of the due diligence will be to the satisfaction of the acquirer. From a seller's point of view, a time frame for completion of the due diligence may add to some specificity as well as give a direction as to what the key milestones are for the purposes of the transaction. When you see the sample clause, there is also a clause which particularly says that the company shall provide all necessary information required by the buyer or the acquirer in order to evaluate and assess the company, its business, and its assets. Now, this becomes important because this provision requires the seller to give to the buyer and its advisors full access to the company's information, records, and personnel for the purposes of its due diligence investigations. Although this paragraph is expressed to be not to be legally binding, or this is not one of those binding provisions, but the seller should avoid agreeing to provide unlimited access and a commitment to supply all information requested. If you see the sample clause here as well, the language in bold provides that as the buyer may reasonably require. Now, this is some optional drafting which may be considered to add a level on a standard of condition, reasonability to the due diligence request that the buyers may have, and lay down some further controls on the buyer's access to the due diligence information. Of course, the idea is not to withhold information here, but these are provisions simply added because the due diligence exercise itself may have a destabilizing effect on the target's employees, customers, and the third parties that it deals with. Sometimes open access like this also may be inconsistent with the terms that the target entity may have entered into in its own agreements, and may be contrary to its own confidentiality obligations. And sometimes there also may be regulatory and other contractual limitations to such disclosures, and therefore some level of reasonability may be built in. Next slide, please.
So before we move, Tanvi, I think two questions that came up. One, I think you briefly addressed, how do you keep a diligence under wraps? There are actually a whole host of other questions, but I'm picking two specific ones. So that I think we've addressed, unless you'd like to add something on that.
No, I don't think I want to add something. The only thing that I would mention here is when you say how to keep due diligence under wraps, is that usually what we see in M&A deals is that there is a fixed or there is an identified group of the deal team from either side. From the sell side, from the buy side, as well as from the the other external advisors. So as long as the information and the process is kept within that close group of deal team, the diligence exercise can usually be managed by that.
Understood. The second one seems to be around this material adverse change. You mentioned that there's a balance on how much detailing you put in. Would you define material adverse change or not in the term sheet? I don't know, but there's a very specific question on this from someone.
Okay. Okay. So before I get into that, I will just, just for the benefit of the larger audience, just talk about that the material adverse change condition here, which you also see in limb 2, which is the condition that a buyer may want to include uh, to ensure that there is no material deviation to the business, and therefore, as a condition, if there is indeed a material deviation between signing and closing or after the execution of the term sheet, then the buyer may prefer not to close. Now, this becomes a heavily negotiated provision at the time of the definitive document, of course, because from a seller's perspective, it adds to a lot of deal uncertainty. Because this essentially means that if this event occurs, then the buyer is not obliged to close. And then therefore the definition of what this material adverse changes becomes important. uh, as I mentioned in the definitive agreement, this is heavily negotiated, but at the term sheet stage, I would refrain from getting into the definition of this particular term, because again, going back to basic principles, the benefit of the term sheet has to be weighed against the granularity that parties may want to get into at this stage, and then leading to overall extension of time just for negotiation of the term sheet. Also, practically speaking, at the term sheet stage, it may actually be quite premature for the buyer also to define the material adverse change, because in the definition, usually when we talk about it in the definitive agreements, there may be certain parameters of the change that may be built in. But at the term sheet stage, the buyer may not have that level of insight into the business to actually prescribe for those events or any value threshold. So I would say, unless there is a particular background and a commercial intent to do so, I would leave the defining of a material adverse change to the definitive agreement. Sami, should I go on? Are there more
Yes,
questions
please.
that you want to
Yes,
take at this
please.
stage? Okay, thanks. So then I think we've already talked about the MAC condition. The limb 3 that you see on your screen is the condition for all corporate, statutory, contractual, and other applicable regulatory approvals to be obtained. This is again, a broadly drafted condition for third-party approvals, which are required to be obtained for the purposes of the proposed transaction. However, as I mentioned before, at the time of the term sheet, it may not be possible for the acquirer or the buyer to really identify specifics around these, and therefore this is broadly drafted. Of course, when negotiations turn to the definitive agreements, the parties will define these specific consents and these requirements more specifically in the long form agreements. The other conditions usually included is for the transaction documents to be duly executed between the parties. Maybe we can move to the next slide. So I think when we talk about transaction documents, the key transaction documents may be identified right at the time of the term sheet. But of course, as parties discuss further and agree to the deal terms further, there may be additional ancillary documents that may get added, and therefore this is more of an inclusive or a non-exhaustive definition which is included in the term sheet to identify just the basic or the key documents to be executed. For example, in this particular case, because the acquirer was acquiring 51% of the shareholding of the target company, a share purchase agreement was envisaged. Because there was a further funding commitment, and therefore in tranches, the acquirer was to infuse in the capital requirements. There was a share subscription agreement that was envisaged, and because the selling shareholders would remain minority shareholders in the company, they were to be given certain minority protection rights as well as their exit, which was to be enshrined in the shareholders agreement. Because A, B, Dr. H were to continue in the day-to-day operations of the company, employment agreements between the company and these individuals were also envisaged. So I think in the broader deal context, the transaction documents that can be identified need to be mentioned into, and a lot of ancillary documents which parties may not go into that level of detailing at the term sheet stage. Next slide, please. Right, so now we come to risk allocation. Detailed discussions regarding the extent and scope of the seller warranties will only take place when negotiating long-form definitive agreements. And once, in fact, the buyer has had the opportunity to conduct its due diligence exercise. In most transactions, therefore, it will be sufficient to simply indicate that in the term sheet that standard representations or customary representations, warranties and indemnities will be included in the transaction documents. Now, from a seller's perspective, it's important to be mindful when the term representations is being used. Because and this again sort of sets out the tone for the definitive agreement as well, because a reference to the term representations means that it keeps the door open for a possibility of an action for a misrepresentation in addition to a contractual claim for a breach of warranty. So therefore, when acting for a seller, one should be mindful whether representations and warranties are being given or the statements are being given as a warranty, with the recourse being a contractual claim for breach. Another important aspect to consider is who is providing the reps and warranties. Now, in the sample term sheet, this was particularly negotiated. Here, there were individual sellers. Each of the sellers was involved in different aspect of the business. None of them wanted, an exposure more than what they had an insight or a knowledge about. And therefore, after a lot of negotiation, it was agreed that the company will be providing warranties, in relation to the business and operations. Now here, of course, there were other complexities involved because the company would eventually become a subsidiary of the acquirer, and therefore what the caps would be and how the recourse would work was detailed out in the definitive agreements. But at least for the term sheet stage, it was prescribed that there will be standard, or customary representations, warranties, and indemnities. Who will provide these indemnities? Obviously, in situations where these warranties are being given by a group of selling shareholders, then from a buyer's perspective, the buyer will usually want the seller's obligation to be joint and separate. This is done so that they are treated as assuming obligations both collectively as well as individually. The effect of this is that the buyer may proceed against any of the sellers or one or more of the sellers for the full amount of its loss or damage. The buyer will normally argue that the sellers can agree the apportionment of liability among themselves. But from a seller's perspective, this has to be considered, again, depending on the role that each of them play in the company. So for example, if we talk about a financial sponsor, in a deal where where the cap table comprises of certain promoters and certain financial investors, the financial investors will seldom give warranties in relation to the business and operations. Their warranties will be in most situations limited to their own title to shares, capacity, authority, and tax. Sometimes buyer may also want to prescribe the heads of the scope of the indemnity as well, and this is specifically in relation to tax or some other identified risk, which are in some ways hard lines for the buyer that they are not going to take, or they need to be made good of if at all a liability arises. From a seller's perspective, of course, they should be wary of agreeing something in principle, because something like this can act like a blanket indemnity, and there may be then arguments at the time of negotiation of the definitive agreement for having a broader indemnity construct. So most often it's sufficient again to provide that there will be standard indemnities or customary indemnities provided. From a seller's perspective, of course, the reference to limitation of liability becomes important, because from a seller's perspective, the term sheet should then also recognize that standard limitations of liabilities will also be prescribed in the definitive agreements. These would be basically your liability caps, time limitations, and other customary limitations of liability. Next slide, please.
So again, I'm conscious of time, but before we move to the next slide, uh, there's a question on the use of the terms customary, standard, and you mentioned at the beginning of your presentation, Tanvi, that there's really no standard format. So the question I think comes from that: how do you interpret or implement the term standard and customary in the actual documents?
Right. So I think, more than interpretation, I would say firstly as a comment that these terms, customary, appropriate, standard, they are not objective. They are subjective terms, and they are intended to be subjective terms because at the term sheet stage, you're not going into any detailing. In terms of the usage of these terms, while a term like standard, could be questioned at a later stage as to what is the standard, because when you're talking especially about, say, a cross-border deal, wherein, say, a US acquirer is buying a majority shares or a business of an Indian company, the standards that they follow will be very different from the standards that are followed in the Indian M&A context. And therefore, what we see more often being used is customary, and that is to refer to what is normal market practice. Of course, in the market there are various studies as well as data available in terms of what are the customary warranties. There are deal studies in relation to the standard caps and the limitations that are being used in the market often. So I would say that each of these terms is subjective. The most common term is customary, but again, the idea is basically to provide for, which is, to provide for the fact that these warranties, indemnities, etc., will be provided, and they will follow what is usually market practice. Should we continue, Samir?
Yes, let's continue, please. Let's continue.
Okay. All right. So in this particular case, as you see now that we go to governance and minority protection, as part of the fact matrix, we saw that the understanding between the parties was that A, B, and Dr. H were to carry out day-to-day operations of the company, and therefore the roles and responsibilities of the parties for post-closing, where different shareholder groups exist on the cap table, or different shareholder groups will be engaged in the operation of the entity, should be set out in the term sheet. Now, because here A, B, and Dr. H, which are the remaining shareholders, were to be provided with certain minority protection rights, that was also identified, which were that they were going to jointly exercise certain affirmative rights. It's enough to prescribe, at least at the term sheet stage, what are the rights that will be provided. The detailing around how those rights will work, or specifically what those reserve matters will be, may be left to the definitive agreements. Of course, in some instances, we do see that specifically for reserve matters or affirmative rights, a schedule may be added as to what these rights will be. Again, in the fact matrix, we saw that because A and B were to be in day-to-day operations of the company, the broad outline as to how the board will work is also set out in the term sheet and is usually prescribed, in term sheets. Specifically in cases where shareholder groups will exist post closing. In this particular case, A and B were to continue to be directors on the board. Because acquirer was acquiring a majority shareholding, it was agreed that they will have one additional nominee than the promoters on the board. So their board representation was agreed to be 3. And then the parties also agreed that to balance out the board and for the best interest of the company, a jointly appointed independent director was to be appointed. Now, so therefore, it's important to set out the basic tenets of how the company will work. Again, detailing around, around how the board will function, how the meetings will be conducted, what additional minority rights will be there, can be left to the transaction documents. Next slide, please. So here now you will see two different exit clauses. The long form clause that you see in the blue box is where we had started. Again, as just to reiterate, the understanding was that after a period of 3 years, the remaining shareholders were to be given an exit. The party started out with setting out what those different modes of exit would be, such as the put option, which they could exercise, drag along rights, where they could, because they also held a substantial chunk, so they could they could have a deal wherein everybody monetizes, a share swap, a tag along right, or an IPO. But what eventually came about in the course of negotiations was that firstly there were certain regulatory challenges in implementing some of these exit terms. Secondly, there was also a lack of clarity among the parties as to what will be the ticker or what will be the commercials around the payout to the remaining shareholders upon their exit. And therefore, eventually what the parties decided and agreed in the term sheet was what you see in the grey box, wherein all that was set out in the term sheet was actually the exit horizon and the fact that there will be in fact an exit given to the remaining shareholders. Again, detailing of this was left out to to the definitive documents. So I think I would just we can move to the next slide. So here, just in the course of the session, we came across different concepts, and I would just like to reiterate some of the drafting points. So firstly, the term sheet should capture the key commercial terms clearly. The detailing and the mechanics of of different provisions can be left out for the definitive agreements. The general provisions may not be restated in a lot of detail, but if there is an exception to those, that should be clearly set out. Again, the idea is to demarcate clearly the binding and the non-binding provisions, so as to be very clear as to what can give rise to binding and enforceable obligations on both the parties. The commercial aspects around consideration or any other matrices or financial matrices should be clearly set out, which includes taking help from worked examples, formulae, etc. Again, where there are key conditions or material aspects which have to be complied with prior to closing, those should be set out. And then generally, the idea is for the term sheet not to be exhaustive, because not each and every deal term can be set out in a term sheet. And that principle should be acknowledged to avoid unhealthy discussions and protracted negotiations at the time of the definitive document as to whether term sheet is so hard-coded that additional points cannot be discussed or additional issues cannot be brought onto table. So I would, I hope you found this session interesting. I will open the floor to more questions. Over to you, Samir.
Great. Thank you very much, Tanvi. Mitesh, if we can flip the slide. I'm conscious of time, but I feel there are two questions from that entire list which we should pick up. I'll request you to address those and then we can conclude the webinar. So the first really is around stamp duty, whether that's payable on a term sheet. And the second question is that where the buyer in a term sheet is a listed corporation, is there any requirement to intimate the regulator or the stock exchanges at the term sheet stage? Once you finish those two, we'll move forward to the next steps.
Right. So I think on the first question, which is whether a term sheet, whether stamp duty is payable on a term sheet, strictly as a matter of a legal principle, it is an instrument, it is an agreement in that sense with certain binding provisions. So, strictly and technically speaking, stamp duty is payable. But often we find that parties execute term sheets without payment of stamp duty. So so it's a matter of practice, but the technical answer to this is yes. The second question, I think, Samir, was that upon execution of a term sheet, do you need to intimate the stock exchange, right?
If the buyer is a listed corporation.
if the buyer is a listed corporation. So again, here, it depends whether this is, a material transaction. Usually we see that if it is not construed to be a material transaction and where there are non-binding, where the term sheet is of a non-binding nature, listed companies may decide not to intimate stock exchanges. But again, it also depends on what the prior practice of the listed entity is. For example, if the listed entity has been intimating stock exchange for everything that it does, even for something like an MOU in the normal business, in its normal business operations, then in those circumstances we see that they take a view that the term sheet also should be intimated to the stock exchange.
I'm afraid we've run out of time. Tons and tons of questions, but thank you very much again, ladies and gentlemen. We will, as we said at the beginning, respond to you offline. Mitesh, next slide, please. So before concluding, we will request each of you to respond to a poll. It should be on your screen any moment now. And this really helps us. All of the feedback that you provide, we take this very seriously as a part of our continuous improvement program. We will also organize for an email request to go to you after this webinar with a form. And the form usually doesn't take more than a minute to complete. And as I said, it provides us invaluable insight and planning fodder for future initiatives. So, great. Next slide, please. With that, we will conclude the webinar. Thanks to everybody who participated in the poll. And we felt that the discussion today was certainly very thought-provoking. To me, some of the key takeaways were that, as we saw, there is a sample term sheet, but there is really no one-size-fits-all solution. It completely depends on what the parties want to achieve and how and when and where. Binding or not, a term sheet is most certainly a moral compass for the deal going forward and a very, very important part of the deal process. And therefore, one must have complete clarity on the commercial undertones and priorities of the parties. And on that basis, think ahead multiple steps so that the right amount of detailing is included and nothing material is left behind. And this is where quality and experienced advisors need to be upfront and center. Finally, I would like to thank Thanvi for the presentation. It could easily be seen as a very dry subject, and particularly when you're discussing a draft document. But given the overwhelming participation by our audience from the Q&A, clearly she has delivered the message. Many thanks also to our live and recorded audience. We hope you found the webinar interesting and a worthwhile investment of your time. Our contact details are on the slide in front of you. Please do not hesitate to contact us should you need to do so. Thank you for your attendance today, and we look forward to being of service again at future webinars.
Thank you.